Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over section A1, and this is an application topic. Apply the conceptual framework for independence included in the AICPA Code of Professional Conduct to situations that could present threats to compliance with the rules included in the code. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour training webinar. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it is free, and we will show you how to save months and months of studying passing these CPA exams. So make sure you check that out, and just letting you know, SuperfastCPA Pro members get access to the full 10-question versions of these videos. And what does that mean? This YouTube video will only be 5 questions, but again, SuperfastCPA Pro members get access to the full 10-question version on the SuperfastCPA Pro member forum. So if you like this and you like our other material, just remember that becoming a SuperfastCPA Pro member gives you access to a whole bunch of great stuff, including the 10-question versions of these videos, so you can get more practice and more understanding. One more thing I'll say about this video before we dive into the questions. This video is actually part 1 of learning about independence when it comes to the conceptual framework, because independence is a pretty broad topic. So we're going to go over certain parts of it in this video, and then we're actually going to go over more parts of independence in the next video. So there's going to be 2 videos about independence just because there's so many different little situations that you can apply it to. So with that, let's dive into the questions for this video. All right, here we are at question 1, and something we always like to point out is to read the last part of the question first. Now, this might not always seem helpful, but on test day, you want to have as many advantages as you possibly can. And you want to be in the habit of reading the last part of the question first, because usually that is what the question is actually asking. It's what you're actually supposed to be doing. So if you read that first, that will give you context for the rest of the question so that you know what you're looking for, you know what you're supposed to be calculating or thinking about as you read through the whole question. So again, this is a test day strategy that you want to get used to. So let's walk through this. Which of these situations would impair the partner's independence? Now again, just think about if that was on test day. You would immediately know you're dealing with independence when it comes to auditing. So that's something really important you want to know as you're reading through the rest of the question, which may not be this short. Maybe you have a whole paragraph you have to read through. And again, knowing that it's about independence will be really helpful. Anyway, so we know it's about impairing independence. So let's go up to the top. An audit partner is leading an attest engagement for a public company. The following scenarios involve relationships or financial interests with the client. So which of the financial interests or relationships is going to impair the independence of the partner? Now, if you have any idea how independence works, you might have an idea which one is the correct one as we read through this. If not, we're going to read through these options and then we're going to go to the explanation to learn more about independence and how it works. So let's read through the options. The partner's spouse is employed by the client in a clerical role with no decision-making authority. Okay. The partner's sibling owns a 10% interest in the client and has significant influence over the company's financial decisions. A partner from a different office in firm A holds an indirect financial interest in the client through a mutual fund. A former senior auditor from firm A, and I guess that this auditor works in firm A, now works for the client, providing consulting services unrelated to the attest engagement. So again, with all that information, which one of these options is something that's going to impair the independence of the partner in question here? Again, if you have any idea how this works, then you probably already know the answer. If not, that's okay. We're going to look at the answer together to learn how this works. All right, here we are. The answer is B. The partner's sibling owns a 10% interest in the client and has significant influence over the company's financial decisions. This is something that would cause an impairment of independence. So let's walk through this. For covered members, independence is affected by the financial and employment relationships of covered related parties if the parties have a direct financial interest or a role allowing significant influence over the client. So these would include people like their spouse or a spouse equivalent, dependent children or just dependents. Maybe they're not your children, but they're dependents. Or close relatives, and that would be something like a parent, a sibling, or a non-dependent child, but only if the relative has a direct financial interest or a role allowing significant influence over the client. So because the partner has a sibling that has a large amount of interest and has significant influence over the company's financial decisions, that would impair independence because they have a close relative that has significant influence over the company. And one thing I want to say that we haven't really said so far, what is independence? Independence is basically an auditor being able to be unbiased, impartial, and free from conflicts of interest or undue influence or things like that. Basically, there's not anything that would make them more inclined to be nice to the company for some reason. So in this case, when they're auditing their sibling's company and the sibling has a big interest in the company, that would cause an independence problem because they might be tempted to overlook certain things at the company in the hope that it helps the company, therefore helping their sibling. So again, that's what independence is. And one thing that I want to point out that we haven't covered yet, what is a covered member? Who is somebody that has to have independence? A covered member is someone whose relationships or financial interests are closely scrutinized for potential independence impairments. This includes the lead engagement partner, individuals who can influence the attest engagement, such as auditors working on the engagement, and partners in the same office as the engagement partner. So partners who are leading it, partners who are in the same office as the partners who's leading the engagement, and all the auditors working on an engagement are covered members. Therefore, they are the ones who have to have independence themselves. And also, we have to pay attention to their covered related parties as well to make sure their independence is not impaired from their sibling or their wife or something like that. Okay, with all that, that's one part of independence. Let's go to the next question. All right, here we are at question 2. Which of the following financial interests does not impair the auditor's independence? A staff auditor is working on the attest engagement for a corporate client. So again, which of these financial interests does not impair the auditor's independence? The auditor has an auto loan from the client's financial institution obtained under normal terms. The auditor owns stock in the client through a trust that the auditor controls. The auditor's spouse owns a direct financial interest in the client. Or the auditor has an unsecured personal loan from the client's financial institution obtained on preferential terms. Okay, so which one of these is not something that's going to impair independence? Just based off of what we talked about in the first question, you might be able to figure this out. If I'm totally honest, independence is not a super difficult topic once you understand what independence is. You just kind of have to think about what things might affect somebody being able to be non-biased, impartial, and things like that. But the thing that's difficult about independence is there's so many different applications. So again, that's why we're doing 2 different videos. So based off the first question, if you want, go ahead and pause the video and try to think through this one to get the right answer. And when you're ready, come back, we will look at the answer together. All right, here we are. The answer is A. The auditor has an auto loan from the client's financial institution obtained under normal terms. That is something that would not impair independence. So let's walk through this. Independence is generally impaired when a covered member has a direct financial interest in the client or certain loans that are not obtained under normal terms. However, specific exceptions allow for certain loans and financial relationships, provided they meet standard business conditions. An auto loan obtained under normal terms from the client's financial institution does not impair independence, as this is a common exception to the general rule. So there is an exception if it's a normal auto loan in the normal course of business, like it wasn't preferential, you didn't get anything special for it, it's just a normal auto loan. That's something that actually would not impair independence because, you have to be able to have a loan on your car. And as long as it's a normal loan, it's okay. But let's talk about the other options. Option B, ownership of stock in the client through a trust that the auditor controls is considered a direct financial interest and would impair independence. Option C, a spouse's direct financial interest, and this is something we kind of talked about in the first question, in the client impairs independence because the spouse is a covered related party. And option D, an unsecured personal loan obtained on preferential terms impairs independence because preferential loans do not meet the exception for standard loans under normal terms. Preferential basically means you got a special loan. Maybe you got a better interest rate than most people, or maybe they gave you a special deal on you didn't have to make certain payments, or whatever the case is. Preferential loans are something that would impair independence, but normal loans, like maybe a mortgage or maybe an auto loan under normal conditions, under normal terms, those are allowed and they do not impair independence. Let's go to the next question. All right, here we are at question 3. Which of the following financial relationships would impair the auditor's independence? A staff auditor is working on the audit engagement for a financial institution client. So again, which of the following relationships would impair the auditor's independence? A, the auditor has a mortgage loan with the client obtained under the institution's standard terms and fully secured by the property. The auditor recently obtained an unsecured personal loan from the client at an interest rate below the standard market rate. The auditor's spouse holds a car loan with the client obtained in the normal course of business and repaid on time. Or the auditor has a credit card account with the client but maintains a balance below the institution's standard credit limit for consumers. So again, based off what we've learned so far, I bet you could figure out which one of these is the one that would impair the auditor's independence. So pause the video, think about this, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is B. The auditor recently obtained an unsecured personal loan from the client at an interest rate below the standard market rate. That is something that would impair independence. So let's walk through this. Independence is generally not impaired when a financial relationship meets standard business terms and does not involve preferential treatment. However, relationships involving preferential terms, and we talked about this in question 2, or unsecured loans can impair independence. An unsecured personal loan obtained at a below market rate interest rate is considered a preferential loan, which impairs independence. So again, they didn't have to secure it with anything, and they also got a below market interest rate. That would be a preferential loan. That impairs independence because when they're auditing that client and they have that special treatment They don't want the client to have bad business because they want to keep having that good loan. So that's why an auditor would have an impairment of independence in this case. For option A, again, a fully secured mortgage loan obtained under standard terms does not impair independence, as it is a common exception allowed by the AICPA code. Option C, this is something we mentioned in question 2. A car loan obtained by the auditor's spouse under normal business terms does not impair independence, as spouses are covered only if the terms deviate from standard practices or involve key positions. And option D, a credit card account with a balance below the standard credit limit does not impair independence provided it adheres to standard consumer terms. So this kind of hit on a lot of the same things as question 2. Now let's go to the next question. All right, here we are at question 4. For which of the following services is independence required? An auditor is performing various services for a client. So again, which of the services does require independence? A, preparing a compilation report for the client's internal management use. B, conducting an audit of the client's financial statements. C, providing consulting services to improve the client's internal control processes. D, assisting the client with preparing a tax return. Out of all these, which one of them requires independence? So if you have no idea what these are talking about, that's okay. If you have a guess, go ahead and pause the video and think through this. And when you're ready, we will look at the answer together. All right, here we are. The answer is B, conducting an audit of the client's financial statements. That would require independence. So let's walk through this. Independence is required for auditing and attestation services where the auditor provides assurance on the financial information or compliance of the client. These include audits, reviews, and examinations of financial forecasts. However, independence is not required for the following. So let's walk through these. Compilations. Independence is not required as long as the lack of independence is disclosed in the compilation report. Consulting services. These are advisory roles and do not require independence unless the auditor takes on management responsibilities, which would be prohibited. So you cannot be taking on management responsibilities as an auditor. That definitely causes an impairment on independence. And finally, tax preparation. Preparing a client's tax return does not require independence unless the services involve acting as management or representing the client in a way that compromises objectivity. And since this is only the second video we're making on audit, we haven't really talked about actual audit reports or compilation reports or consulting services or different things like that. Of course, we will get to that. So if you don't really understand what those are, that's okay. Just remember that as far as independence goes, as far as that concept goes, you have to have independence when you're conducting an audit or a review or providing assurance on financial information, but you do not have to have independence when it comes to compilations, consulting services, or tax services, as long as you disclose that you're not independent or as long as you are not doing things that you're not supposed to do, like having management responsibilities. So those are the situations where you have to have independence. Now let's go to the next question. All right, here we are at question 5. Which of the following situations would impair the auditor's independence due to their prior employment with the client? An auditor is working on the engagement for a client. So again, which of the following situations would impair the auditor's independence due to their prior employment? So let's walk through these. A, the auditor worked as the client's financial controller 2 years ago and is auditing periods that include their tenure at the client. B, the auditor worked as a marketing analyst for the client 5 years ago and fully disassociated before joining the audit firm. C, the auditor worked for a different company in the same industry as the client and interacted with the client as a vendor during that time. Or D, the auditor provided consulting services to the client before becoming part of the attest engagement team, but did not assume management responsibilities. So out of all those, which one of them would impair the independence of the auditor? Now, based off of what we've talked about and kind of based off of intuition, I bet you could figure out the correct answer. So if you want, go ahead and pause the video to see if you can get the correct answer. And when you're ready, come back. We will look at the answer together. All right, here we are at the answer. A, the auditor worked as the client's financial controller 2 years ago and is auditing periods that include their tenure at the client. That would impair their independence. Prior employment with a client can impair independence if the auditor is auditing financial statements from periods when they were employed by the client or had responsibilities that affect the financial reporting. This creates a self-review threat, as the auditor may end up evaluating their own work. In option A, independence is impaired because the auditor is auditing periods that overlap their tenure as a financial controller, creating a self-review threat. So this would make it so they are not independent in this case. But for option B, independence is not impaired if the auditor fully disassociated from the client, their role was unrelated to financial reporting, and they are not auditing periods tied to their employment. Option C, prior interactions in a non-employment context, such as working for a vendor, do not typically impair independence unless they create other conflicts of interest. And finally, option D, providing consulting services to the client does not impair independence as long as the auditor avoided management responsibilities and fully disassociated before joining the attest engagement. So it is okay if you worked for a client previously and now you're auditing that company, as long as you have completely disassociated from the client and you're not auditing the period that you were working for the client. And again, as I said, there's a lot of different things that have to do with independence, a lot of different little teeny topics. And before we do anything else, let's do one more part of the SuperfastCPA CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you the independence requirements when it comes to covered members and their covered related parties like spouses, siblings, parents, things like that. You've seen multiple questions about that, or whatever the case may be. And as you notice these, you write them down as pillar topics. You write them out in your own words as the most important things you learned from the questions that day. And as you're doing this each day, you will be building your own personal repository of the most important things that you need to know for the exam in your own words so that you're ready for exam day when the time comes. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics for this video. So let's just go ahead and dive straight into them. First off, covered members and related parties. Independence is impaired when covered members or their close relatives, and that would be things like their spouse, their dependent child, or sibling. There's a few others, but of course, some things like that, have a direct financial interest or significant influence over the client. Non-close relatives, such as cousins or in-laws, generally do not impact independence. Next, let's talk about direct and indirect financial interests. Direct financial interests in a client, such as owning stock, always impair independence, while indirect financial interests, such as mutual funds, do not, provided they are diversified and immaterial. Now let's talk about loans and financial relationships. Independence is not impaired by normal loans, such as auto loans or mortgages, as long as they are obtained under standard terms, but it is impaired by preferential loans or unsecured personal loans at below market rates. Next, let's talk about prior employment and self-review threats. Independence is impaired if the auditor audits periods during which they were employed by the client or were responsible for financial reporting, creating a self-review threat. And finally, we talked about the engagements that require independence. Independence is required for auditing, attestation, and examination services, and that would be things like financial forecasts, but it is not required for compilations or consulting services, provided the lack of independence is disclosed where applicable. And with that, we've gone over the pillar topics for this video. And again, this is only the first video when it comes to independence. There's a whole bunch of other different applications that we haven't quite talked about yet. This was only a few of the different applications when it comes to independence. So make sure you watch the next video when I post it so that you can learn the rest that you need to know about independence. And with that, that is the end of this YouTube version of the video. Remember that SuperfastCPA Pro members will get access to the full 10-question version of the video that I'm about to finish recording after this, and they will get more practice and more understanding. So if you like this, make sure you check out becoming a SuperfastCPA Pro member. And the easiest way to do that is first by going to SuperfastCPA.com and signing up for our free 1-hour training webinar where we will teach you the key ingredients to passing the CPA exam, and that will give you a better path to figuring out how to become a pro member of SuperfastCPA. So make sure you check out the webinar, make sure you check out becoming a pro member, and with that, I hope you liked the video. If it was helpful, make sure to like it and leave a comment, and I will see you in the next video.